welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra. We are going to increase your financial IQ today with a discussion about a relatively new type of investment, generically called buffered strategies. And to walk through all of this, I asked Brett DiPasquale, my colleague here at Elliott Wealth Management, to join in on the discussion because candidly, in our team, he is the expert on buffered investments and takes the lead with any activity research that occurs with buffered specifically. And we have begun to use them over the last stretch, much more than we did previously. And again, Brett takes the lead with that. So, Brett, hopefully that was a good intro.
It's a great intro. Thanks again for having me.
Yeah. So, of course, let's just stay at the beginning. For everyone listening, we're going to talk about an investment strategy here, but this is educational in purpose. Educational. This is not meant as specific investment advice for your own personal situation. You could always call, email us, schedule a meeting with us if you want to talk about your individual situation. But the purpose of today's discussion is an education on buffered investment strategies. So to kick it off, Brett, at a high level, what is a buffered investment strategy?
So think of a buffered strategy as buying an index that helps you limit any downside loss that you have, but also allows you to participate in that index to acquire gains over a specified period of time. So a very loose example of this would be the S&P 500. Most investors are experienced with the S&P 500, a lot of ETFs, mutual funds on this specific index. So let's say you bought the S&P 500 and you chose to have a specific downside protection to it. So let's say you wanted to protect yourself against 20% of any loss over a 1-year period of time. If the S&P 500 index is down up to 20% during that stated period, so 1 year, you don't lose anything. If it's down over that buffer, you lose the difference between the buffer and the loss. So if the index is down 22%, you're protected against 20%, you lose 2. Now, in trade for that protection, you're going to be capped on what you can make. So let's say if you chose the 20% downside protection, you may only be able to make 14 or 15% for the year. Now that's a trade-off, but at the same time, that's just an example, just to kind of kick it off of how they actually work and kind of get a good visual in your head.
So if you generally invest in the S&P 500 index, using, again, that is our conceptual education benchmark, you invest in that index and you could capture all of the upside as well as all of the downside. And historically, it has done very, very well. But long-term investors also know that that's punctuated by some serious downturns that occur every so often. 2022, as an example, was a terrible year. Go back to the great financial crisis. That was a terrible downturn. I think the S&P 500 might have been off some 45% or something from the peak to the bottom during that turmoil in the market. So in this instance, you give away potentially some upside in exchange for some downside protection. Is that a good summary?
Yeah, exactly. The name of the game with these type of investments is limiting your volatility in the market while still remaining active and invested.
So when you go into a buffered investment, it's not an index in and of itself, correct?
Correct. So it's more of a strategy. So whoever you buy this buffered investment from will be doing different investment strategies on the index, such as buying options around it. But that's not what you're necessarily concerned with. You're more concerned with what is the protection that you're getting on it and what is the upside that you're getting on it over a specific period.
So it's not an index, but it often is an ETF, an exchange traded fund, is the uh, expression of the strategy in the form of an ETF. Is that correct?
Yeah, the ones that we're talking about today are ETFs. There's some other wrappers that these type of strategies come in, but that's a discussion for another day.
Okay, so there are some insurance products that could incorporate buffered strategies. There are some other investment vehicles that could encompass the strategy, but I think most of the activity, including the work that we do for clients, is centered around ETFs, right?
Exactly.
So to give some statistics to people that are listening, and I looked this up in preparation for the show, of course, but in 2019, according to BlackRock, there was $5 billion in assets under management in buffered strategies, $5 billion in 2019. That is ballooned to $181 billion by the end of 2024. So from 5 billion to 181 billion. And ETFs have long been the area of investments for Main Street Americans where you're getting the most amount of innovations. ETFs themselves were innovative. And along the way now, we have innovation stacked on the original innovative ETF investment structure. And the latest and greatest example of that is Buffered's. You'd agree with that, right, Brett?
Yeah, absolutely.
So why do you think that this is gaining in such popularity, generally speaking, not even talking about why we have used them in an increasing number of asset allocation decision making that we're doing?
I think it really comes down to three things. I think it comes down to the volatility in the market, giving clients stability, and also in the bond market recently, it's not performed how it's necessarily performed in the past. So it gives a bond alternative where you still have protection, but at the same time, you're able to participate in the market. But I think the first two that I covered are the most important. Having stability for the client in a very volatile market and knowing what your protection or what your investments are protected up to. It gives a sense of calm. It's something that we can define, we can measure when we're reviewing the portfolio with clients. So it gives them some nice structure and stability through some volatile times like we've had recently.
If I could add on to that, two other sort of scenarios. One is an investor that is risk averse and a little jumpy uh, at certain periods of time, or generally a little jumpy. This often allows them a tool where they could stay in the stock market using S&P 500 as the example we've been using, and it doesn't have to be that, right? It could be other indexes, correct? It doesn't, the buffer doesn't have to be S&P 500. There are other indexes that could be used in a buffered strategy, right?
Oh yeah, you can get the S&P 500, you can get the Russell 2000, you can buy the Qs, so technology heavy or anything, even the Europe, Asia, Far East, international indexes. So there's a lot of different choices out there.
Yes, agreed. I imagine there's some with the Dow too, right?
Yes.
So going back to my illustration, so somebody that's a little nervous about the market, maybe at this time, or is generally a little jumpy, this is a tool that they can use and we could use with them to have them be in the markets, to participate in some, if not all, of the upside if things go great, but give them the peace of mind and the safety provided by the downside protection. And you used in your example, Brett, 20% downside protection. There are different strategies, right? It could be 15%, it could be 10, it could be 5, it could be over 1 year. but also in certain instances, it could be over a shorter period of time, right?
Yeah, correct. So you can choose anything from 10% protection all the way up to 100% protection. It just depends on what the offerings are at that time, but they're very flexible. So it's kind of a build your own type deal.
And there's a lot of variety. And with this innovation, there's more and more of these strategies and offering that are coming to market, of course, because it has attracted so much investor money. There are more players, more strategies, just a larger number of offerings out there for investors and professionals like us to select from. So then that client I'm talking about, that investor I'm speaking about, can get some upside potential in one or more indexes, but also get a sense of peacefulness and a bit of safety because they have some downside protection that they would not have if they just invested in the index by itself. So I think that's one example of why this has attracted attention. Is that a good illustration, Brett?
Yeah, absolutely.
And then the other one I would say is you have Americans, a large portion of the investor population where money is invested are getting older. And it's almost, I don't know if this is exactly true, but it's sort of like the first generation that is retiring that really are not as reliant on pensions as previous generations, meaning that the vast majority of their wealth, their retirement nest egg, their liquid nest egg, is in the investment world. And they've built and accumulated money because they probably have had success in the stock market over time, investing in the same indexes we're speaking about and participating in the stock market, which does very well over time based on history. And they're looking at 65 or 70 or 60, whenever, when they're looking to retire or approaching retirement, they don't have the same risk appetite that they had before, but yet they're not ready to necessarily abandon the stock market for things like CDs, which still have low rates compared to the long arc of history. So I think this is attractive to them because it allows them to keep doing what they had been doing with this twist that provides the downside protection so that older individuals can sort of get maybe their cake and eat it too, where they could participate in the markets but have some safety that they didn't used to have. How about that thesis?
Yeah, I think that's a good one. And I think the grand scheme of things here is adding protection and a little bit of certainty to the portfolio, especially for investors, like you said, older investors who aren't necessarily ready to turn all the risk off, but this allows them to really have some nice, good upside with the trade-off for some good protection. So it's been very well received by clients. Um, yeah, it's been a great strategy for us.
And this strategy that we've used here at Elliott Wealth Management Services, and as I already described, with your leadership, we're doing more of this, not less. And there's a lot of factors for that. But there is not, or would you advise someone to take quote unquote all of their money or all of their investment money and put it into buffers?
No, this is something that should be incorporated with the entire portfolio in mind. It's obviously going to depend on the individual's risk tolerance, how much appetite for risk that they have, and what the rest of their portfolio looks like. So it's very important when you're selecting one of these to make sure it's fitting in to the current investment strategy that they already have.
So there's no instances where we have clients that have 100% of their money in buffers. This is something that gets inserted into an overall investment and asset allocation strategy. It's one piece of a whole, but is not meant, at least how we're using the tool, as a end all be all for an entire portfolio.
No, absolutely not. And I think that goes with a broader statement too of whatever you're investing in, it shouldn't be all in one thing anyway. So you should always have a nice diversified portfolio in different areas of the market and different areas in general.
And because, Brett, this strategy it's index oriented, which is incredibly popular, and we use a lot of indexing strategies, non-buffered traditional indexing strategies. When you look at our investment portfolios for clients, there's lots of indexes represented. You mentioned some of them, the S&P 500, the NASDAQ, and so on. And part of the appeal of indexes, especially if you listen and read the financial media, is that they are an inexpensive offering. The cost that these investment vehicles charge tend to be lower than other strategies. And that's part of the reason why index ETFs have become so popular over the years. So are buffers as inexpensive as the pure indexes, generally speaking?
No, nothing's really going to be as inexpensive as a pure index just because of the mechanics of how they build the fund. So the buffered strategies, depending on which one that you get, will be a little bit more expensive. It's nothing outrageous, but at the same time, in order to provide you with the protection on top of that investment, that's what you're paying for. You're paying for the protection that that fund gives you.
And if it's the right tool and it provides you some peacefulness and fits with your investment objectives, working with us, we're gonna take a close look at that and have agreement on that. Then paying a little bit more for this particular investment strategy might be worth it because of what you're getting out of the deal, and that most notably is some element of downside protection. So then it's money well spent because you can't get that in an index unless you go into advanced trading strategies like options or hedging or straddles and things like that, which mainstream Americans typically are not using in their portfolios and not really in our area of expertise here at Elliott Wealth Management. So these buffers give all of us a new outlet to manage risk for our clients, either based on their risk profile generally or based on circumstances in the market. So in 2025, we're roughly at the midpoint of 2025 as we record this. Can you talk before we finish up, just generally why we have been using buffers a little bit more in addition to what we've already described, but talk a little bit about why it's a little timely given where we think we are in the economic cycle?
Sure. So coming into 2025, obviously in February, stock market highs. So we were a little weary to begin with based off of some valuations coming into the year. We had an idea that there was probably going to be a correction. We didn't know when, we didn't know how much, no one did. And back in April, we saw the market correct with some of the tariffs or threat of tariffs being put on. So over a very short few days, the market dropped very quickly. So one of our responses to that was, we don't know if the market's going to continue to drop. We don't know if it's going to recover. What gives us a really good strategy for clients is we know that they don't want to continue to lose or lose any more than they have. But we also know that it's incredibly important that if the market, if and when it bounces back, that clients are able to still participate in that and make themselves whole, plus gain some on top of that and be successful for the rest of the year. So we implemented some buffer strategies then. That way, when we're speaking with clients, we're letting them know that we're limiting some of their loss, but also too, we're not taking them out of the market. We're putting them in a place for success. So over the rest of the year, when the market bounces back, inevitably it will. It obviously has. They're in a good position for success, but also still protected. And it's a great story. It's great protection for clients, and it was very well received.
So it's important to note clients, if you're listening to this, and if you're not a client, we'd love for you to become a client, is that uh, the strategy that we're using buffered are liquid. Now, there are others that we could use and we may use in the future, but generally speaking, the way that we're using buffereds is they're liquid. So we could enter into these positions and exit out of these positions. So that gives us lots of flexibility to make changes based on either what the client wants or needs in their personal situation or based on the market economic conditions. So that's an important note. And I'll add, Brett, to what you said. Coming into this year, we looked at things and we were not as bullish, not as optimistic about the markets in 2025 as we were the previous couple of years. 2023, 2024 were banner years for the markets generally, the stock market indexes generally. And we thought, like you said, based on valuations and other factors, that there was a reason to be a little more cautious. So our part of our positioning with many of the investment allocations that we're running here at Elliott Wealth Management, we incorporated buffers for exactly the reasons that we articulated in the discussion so far. It gave us a chance to have upside participation in the markets, but with an added element of safety provided by downside protections. And as of mid-year, we're really happy with this, and our clients are too, right, Brett? Because the markets, generally speaking, the stock market indexes are up, but it's been choppy. It hasn't been as explosive as the previous 2 years. And with all that's going on geopolitically, politically, what the administration, President Trump and his administration is doing, we feel comfortable that we have this added defensiveness that we didn't have the previous 2 years, this added layer of protection for a portion of our portfolios. And so far, it's worked out well. Wouldn't you agree, Brett?
Yeah, absolutely. The one thing I will add on, just as a side note about the liquidity, as you said, completely liquid. We can trade these things whenever we need to, if we need to do that. I will say that depending on the time frame that we buy one of these, and let's just call it a year, if the market were to be down during that year and into that buffered protection, it would be in best interest to keep that for the remaining period. That way you get your full protection. So there is a calculation to be made inside of there. So if you exit before the end of the stated period, you might not get the full protection or the full upside. So before any of that happens, we always take a look at that and make sure it's an advantageous trade for the clients. But those are details, but I just wanted to throw that in there as well. That was important.
No, that's some good information. So let's end it there. Brett, appreciate your time explaining this and discussing this on the show, and also the work you're actually doing with this, taking the lead on this particular investment strategy for me and the rest of the team, and of course our clients here at Elliott Wealth Management. So listeners, I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meanwhile, if you want more information about this or anything else, whether you're a client or if you're not a client, go to the website, elliottwealth.com. You could sign up for a complimentary consultation. Or if you have a great relationship with us, like most of you do, just call or email, do what you normally do if you want to pick up on the subject in greater detail. Thanks again for listening. We'll be back with you soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.